Good morning. Let's get it. Let's get it. So, been kind of MIA, MIA for a little bit, just kind of directing the Discord group that you can find in the description if you want to join. Free of charge, by the way. No charges. Nobody gets charged. Been MIA for a little bit. Contemplating, discussing with the group, kind of figuring out where things will go, where we think things will go. And very interesting stuff. So CPI data released today, right? What did everybody do? What did everybody do? Expectations are down, right? Like we're supposed to go down because CPI data is bad. But what did everybody do? Well, everybody specifically shorted the bottom. So what should we, I would say, in turn expect that's going to happen if everybody's shorting the bottom? We're going to get a big short squeeze. Will it be a sustainable one? I don't think so in the least. But this is why you don't short bottoms. It's basically it, guys. Got to really, really, really try and stay away from the hype train. Even if everything leads to down, you can't be late to the game. You got to be on top of it, right? That means you got to be shorting the highs. So when everybody's saying go, 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 you should say no, no, no. When everybody's saying sell, 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 you should be saying buy, buy, buy. That's basically it at the end of the day. So something I want to discuss here, and so people understand the CPI data and kind of what it measures and how it works, is what it actually measured, right? So let's go over CPI data and why it's important. So 7% education, other 3%. That means miscellaneous is BS, right? Food and beverage, 15%. Housing, 43%. So when we're looking at food and beverage, what do you think that means? Do you think that means like your groceries from the grocery store? Yeah, that's pretty much what it means. Recreation, 6%. Medical care, 8%. Transportation, 15%. Apparel, 3%. And your housing, which I believe I said earlier, but maybe I didn't, 43%. Now, let's understand why these are important. Out of all these categories, can you do without any of these at the end of the day and be able to survive? In the current world, I'd say in today's economy, today's age, no. You need all of these, right? You need food and beverage. Why? That's how you live. Otherwise, you won't be here. You need housing. Why? It's shelter. It's a place to live. It's the only way you can get a shower, wash your clothes, so on and so forth, so you can go to a job presentable and be able to work. Education, 7%, right? Do you need education? Yes, everybody needs education, especially children. Children need education. So if education costs go up, that means that the parents' costs also go up, right? Recreation, 6%. Is recreation necessarily needed? Not really, but for mental health purposes, I would say yes. In a sense, yes, it is. Medical care, 100% needed, right? Some people have monthly drugs that they need to be able to live, for instance, right? Some people have insulin, some people have other medicine that they need for, psychosis, all kinds of stuff. Transportation. I mean, we could all walk to work, we could all bike to work, but the reality is most of our jobs are just too far to be able to do that. So we have to use a vehicle, or we have to use a bus or some sort of transportation. So keep in mind when you're looking at transportation, that's not just specifically talking about gas for your vehicle. That is also speaking on bus transportation. It's also speaking on flight transportation. Many, many, many forms of transportation. This covers all categories of transportation. These are the essentials of what you need. So when these things in specific, and this is what the Fed is currently looking at, go up in price, it means your overall cost of living goes up in price, right? So if your overall cost of living goes up in price, what does that mean? Well, it means that you'll spend less in each sector. You'll try and find ways to cut corners. But if it's continually going up, even though you're trying to cut costs, what does that mean? That means inflation is outpacing your deductions, right? And you can only deduct so much until life is pretty much unlivable or close to it, right? So when you think about things like that, that's what the Fed is trying to squash. Even though the Fed knows that we're going to feel the heat at the end of the day when it comes to these rate hikes, the Fed has to continue to keep putting pressure on the market because he needs to drive these prices down. How does he do that? Well, the Fed basically comes in and they reduce demand, right? They're trying to get you to buy less, which will in turn cause the people selling these items to reduce prices, and in turn will reduce their margins on the businesses, and in turn harm the businesses in the long run to be able to cause the business to deflate their prices and possibly lay off a bunch of people to try and keep their margins, which will ultimately end up in a pretty big unemployment situation. The more people that get unemployed, the less money is circulating. The less money is circulating, guess what? Now we've got a recession, which is what we're in. At the end of the day, this is kind of the data of all, and the data that the Fed's currently viewing, right? So when we think about things like that, that's the CPI in a nutshell. I'll cover it a little more in detail based on some information that I found over here at a forex site. And I think this is a really interesting site, right? So it's called Forex Academy, best edition, whatever. So it goes through its own description of these items. Now, granted, I like this article because it was made in 2020, when right before they started changing definitions of everything and swapping things around and trying to pretend like this is that and that is this. So, what is the consumer price index and how can you trade it? The consumer price index is one of the major items on any forex economic calendar, right? This means everybody can see it. That means if everybody's in the majority and everybody knows that this is bad and that is good, if everybody knows that, expect the opposite, right? Which is the short squeeze that we're currently under right now. According to the CPI definition, it tracks the change in the price level of the basket of goods and services. And I'm going to show you in the chart how it already called for this. During the last 12 months, the exact compositions of items and methodology of calculations does vary from country to country. However, CPI is still considered as one of the most important measures of inflation. This is why the Fed measures it, guys. This is why he pays attention to the CPI. For the regular trader at forex markets, following the latest developments in the consumer price levels can be useful in two ways. Firstly, it is worth keeping in mind that most of the world's major central banks target inflation. Therefore, the latest changes in CPI can give some clues regarding the future path of the interest rates and monetary policies in general. So this means what the Fed's going to do in the future, right? So when you see CPI data, you can kind of measure what the Fed's going to do in the future. So CPI data is showing that inflation is going up. You can expect the Fed is going to stomp that out with higher interest rates. If CPI data is showing inflation is coming down, aka a deflation in the prices of all these items, you can then expect that the Feds might pause, not pivot. I hate when people use the word pivot. The Fed will not pivot. He will pause, take a look at what's going on, and maybe evaluate the market differently later on in the future. But a pause may come in, right? Not a pivot. People consistently talk about pivots like they understand what pivots are. Pivots and pauses are two different things. A pivot is the Fed coming in and quantitative easing. Pause is the Fed pausing all motions, aka not raising rates, not lowering rates, right? They're pausing to look at the market. I think a pause would be more in order in the middle of an inflationary environment if you're trying to evaluate the market, not a pivot. If in the given country the inflation rises well above the desired target, then the local central bank may respond with hiking interest rates, and this can strengthen the currency, right? So they may respond with hiking interest rates, which may increase the currency, which is what we're seeing right now in the DXY with the dollar, right? The second CPI effect on Forex usually takes more time to manifest. And I'm going to show you guys today how you can tell where you are in the chart and tell when you're looking at a short squeeze potential, right? The short squeeze is a short rally. It's going to go down again. It doesn't matter, but we are in a short squeeze. The second CPI effect on Forex usually takes more time to manifest. According to this is what I mean by short-lived rally. According to purchasing power parity, in long-term currencies with low inflation tend to appreciate the ones with a higher rate of price level increases. This can be one way to explain the decline in the USD CHF and USD JPY in recent decades. That was in 2020. Not really the case right now. Consumer Price Index explained. According to the official website of the Bureau of Labor and Statistics, the Consumer Price Index measures the average change over time in the price of urban consumers with baskets of goods and services. This consists of several spending categories. To find out more details, let us take a look at these Consumer Price Index tables. As we can see from the chart above, in the Consumer Price Index, The formula includes housing expenses, which represents the largest component of the CPI, composing more than 40% of the index. This is the majority of what you spend when you spend to live. It's for your housing. Everything else is much cheaper than that. Food and beverage categories, which compose of 15% of the index. Now, food and beverage includes what you buy at the grocery store as well as what you eat out. The transportation sector having approximately 15% share in CPI. Medical care, recreation, education, apparel, and other goods and services. How is the CPI calculated? Each component has a list of subcategories. For example, the food and beverage section has bakery products, meats, eggs, dairy products, fruits and vegetables, sugars and sweets, snacks and baby foods, and other items. The composition of CPI is not fixed. Every single year, the weights of each category are reviewed and adjusted to account for changes in consumer behavior. It is updated every month, and the Consumer Price Index calculator is also available on the BLS website. Depending upon the economic conditions, the rate of CPI can fluctuate significantly. However, according to the official data, the average long-term inflation in the US stands around 3%, which we are currently above 8%, which is extremely bad, right? The measure is one of the most important economic indicators. In fact, like many other central banks, the Federal Reserve targets 2% inflation in the medium term. There is an obvious question, why exactly 2% and not some other number? The higher inflation can lead to the rapid depreciation of the purchasing power of the currency. This is what I've talked about many times. This is why 2% always has to be the number to come back to. And also, that's the way our system is built, around a 2% inflation. That means that if you go outside of that 2% inflation, we now have to redo our business model for our country. Not gonna happen. We're gonna always stay 2%. Wipe out, and everybody always says, well, why not just 4? Why not 8? Why not? Yeah, tomorrow it'll be 4. 2 years from now it'll be 8. 10 years from now it'll be 20. Like that's how it goes, right? So no, it's always gonna be 2. Even 2% annual inflation assumes that prices will still double every 36 years. At 4%, this process can take only 18 years. So keep in mind, if we raise inflation to 4%, it would take half the amount of time before we start raising it to 8%. And then half the amount of time before we start raising it to 16%. And then half the amount of time before we start raising it to 32%. Do you get what's going on here? This is why we stick to the numbers, because we will have to keep raising if we start doing it. Therefore, if the Federal Reserve started tolerating such high levels of price increases, that can certainly undermine economic stability and the reserve currency status of the US dollar. So then why not target 0 or 1% CPI? The official explanation by the central banks is that this can increase the change of deflation in the economy. The problem being that it is difficult to enforce the negative interest rate policy. So what do you mean by this? Well, for example, if inflation rises to 3%, when the central bank can raise rates, perhaps even exceeding that rate, and curb those price pressures. However, if the CPI falls to 1%, when the Federal Reserve cannot do the same thing and enforce negative rates. So negative rates would be like negative percentages, right? You don't want negative percentages, you want 0. So the cool balance is that the Fed can go all the way to 0%, but inflation needs to stay at 2%. Otherwise, if the Fed goes 0% and inflation's at 1%, we're -1. Get it? That's basically how it works. If, for example, one day the Federal Reserve rate dropped to -1 or -2%, then instead of paying interest to the bank, the depositors will pull out their money and keep their savings in cash, avoiding those potential losses. So from their perspective, it is easier to address inflationary pressures than to fight deflation, right? So they keep inflation rolling so that way deflation doesn't cause you to take out all your money and the system collapses. Actually, there is another reason for the 2% inflation. The targeting policy, which is often overlooked. In majority of developed countries, both governments and households have a very large amount of debt, right? Which is what our current 21 trillion. If the central banks tolerate deflation, then the liabilities of those entities would gain purchasing power and make the burden of repayments incredibly more difficult. On the other hand, with 2% inflation, the real buyer power of those debts will slowly but steadily fall, which can benefit indebted governments and households. So essentially what they're saying is like nobody would invest if there wasn't an inflationary environment. The inflationary environment, it invites investing, it invites the sharing of money, right? That's how this whole thing works. If we didn't have an inflationary and we had a deflationary environment, there's no reason to have a central bank. There's no reason to have a banking system. There's no reason to have a government because we all hold our own cash. There's no benefit to putting it into something. There's no return. This is how deflation works. This is why you stick to an inflationary model, because the inflationary model makes sense to be able to promote and to provide an investing environment. How does the consumer price index affect forex? Okay, so what I'll do, this is what I'll do. For those of you that are in my Discord, I'll put this in there for you. You guys can read through the rest of this, right? Long-term CPI, all that good stuff. I don't want to make this video too long. I want to get into the charts. So we've went through the basics of what is going on, what the CPI is about, and how we should read it and why it's important and why inflation is important, right? We want to know all these things. Now let's get into the charts and let's see what's currently going on. So let's look at where we are. So a couple different things here, okay? Where is the VIX? Where is the VIX? Well, if you look at the overall trend of the VIX, we're at the highs of the zone, right? So a pullback in this area, it's good potential it'll happen, right? Really good potential. So what happened? We got a pullback, right? We're at the highs. Now we are expecting some kind of takeoff, whether it be here or whether it be a pullback into that, we don't know, right? But we're expecting some kind of takeoff, some kind of explosion. This is going to be our big dump we're looking for. It's going to be our 2008, 2009 scenarios. We're looking for a higher move. It'll either be up here to 103.95 or even as high as 148. Crazy if you follow trend. All right, so this is kind of the idea with the volatility index, right? So we know if we're shorting here, we're probably shorting the bottom of the market because we're at the high, right? So really you should have been shorting somewhere around here because that's where price starts to build and that's where price starts to dump, right? Volatility starts to build, price starts to dump. So if we look at this, this is August 1st. Yep, August 1st, 2022 on the monthly. But we can look at it even as early as, we'll look at like August 1920th, right? 1920, we'll go 1920th. So August 1920th. So actually August 1st would have been perfect to short this thing because you'd be at the high. So here is the overall market on the monthly. Let's run into the daily. Let's look at August. So this is kind of where I told you guys over here, hey, start looking to short, right? And I told you guys right here. What did price do? Boom, boom, pump, boom, pump, boom. Looks like we're catching a nice pump back up. And really this, to me, looks like something that could swing all the way up here and then maybe dump from there. So it's a big old short squeeze, guys. Big old short squeeze. So as much as I want to get into this, I want to get into the S&P first, and then we'll get into Bitcoin, right? Because the S&P is some pretty crazy stuff going on. So let's look at the S&P real quick. Biggest God candle in history, right? Not sustainable in the least. So you're probably like, what is going on here? What happened? So you can see my price expectations, guys. Like it's all the way down here. We came down, we hit the liquidity where? Here? Is there something here that I missed? No, there's nothing here. It's a short squeeze. That's all it is. It moved in the middle of the market right here. There's literally no reason for price to bounce here. Look, no price action anywhere. The only price action is up here where we're currently resisting. And we could even potentially run all the way up to this 3790. That's what I'm looking for, right? I'm looking for that 3790. At the end of the day, though, this is going to be a short-lived rally. So CPI data came out bad. Everybody shorted. But where did they short? Well, they shorted here. 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 I know I said that 3 times, but they shorted here. Where should they have shorted? Here, here, and here. And well, nobody knows the top. We're calling it the whole time. We're calling it the whole time. So where's price? Price moves down. It's this low of middle of nowhere. There's really no price action in the zone for a bounce. So this to me is a false move into a massive just pump, right? Now I'm going to show you guys the falsity of this, and I covered this in yesterday's Zoom for those of you who were there. All right, and I said, look at this trend. This is the true trend, right? A downtrend to here, right? Now, the thing that we saw is we got the lower low and we got the higher high on the RSI. What does that signify typically? It signifies a trend reversal. And where did we first see that? Right here. Trend touch. You see what's going on here? Lower, high, and then what happens? Well, they shake out the what? The longs, and then short squeeze the bears into a short. This is not going to be a long-lived rally. Why? Why is it not going to be a long-lived rally? It's not going to be a long-lived rally because it's not true. What's the true trend? The true trend is here. The true trend is here. That's a downtrend, right? And what else? We have a short trend here. And that short trend is here, right? So what I covered in yesterday's Zoom that we had is I said, we'll probably see them bounce here because that's what they're doing, and then come back up. And you can see right here and hit the center of the 50, which under the 50 is bearish, right? We've talked about this in the past. Under the 50 is bearish, and then come back down to the trend. So what does that mean for the market? Well, it means a pump up to probably 3,800, 3,790, all the way back down to the low. Boom. Short-lived rally, guys. Short move on the RSI, short move here, short-lived rally up here, short-lived rally on the RSI, bigger trend ultimately wins. Now, you say I'm wrong, you can quote me on it, whatever, but that'll result in this trend right here. And I think this will be much closer to the bottom than a lot of people think. Not this. So with that being said, that's the SPY in a nutshell, right? Nothing too crazy. We got Tesla doing what? Well, Tesla is looking to come and retest resistance. That's all it is. That's all it is. Look, boom, boom, over here, right here. We're looking to come back up and test resistance, only to come deeper. Boom. That's where I'm looking for Tesla to come to, 186, 185, somewhere in there, right in this up. That's where I'm looking for it to come back to. All right, let's come over to shopping. Shopping had a nice pump back out of its zone, but ultimately I'm looking for the same thing. I'm looking for a move into a move. Boom. That's my target. Come over to Ethereum. We can do the same thing. I'm looking for a quick move. Now, here's the thing. With crypto, it's not going to be as high. I'm expecting crypto to come back up to the highs. Boom. And boom. That's my expectations for crypto. So we are going to recapture these lows. Now, could those lows be here? Sure. They could also be here at the low. I think this wick gets recaptured. We come back down to 800. Come over here to Bitcoin. Similar situation. We got a nice pump. Again, the daily close is going to be the ultimate decider on this. A lot of hopium, a lot of BS going on right now with these short squeezes, but they were obvious. They were there. Come over here. We look at the RSI. What are we looking at? Well, we're looking at an uptrend, right? Uptrend. But what do you notice right there? You tell me, what do you see? Well, it looks to me like a broke trend. Do I think that it'll get back above it? I don't know. Maybe it's more like this, right? But ultimately, either the bottom of this trend while it's up here is your rejection, or it'll swerve back up, hit this, and then reject, which will be a move back up and then reject to the lows, and possibly to the lows here. We'll see at the end of the day for that one. But those are kind of my ideas right there for Bitcoin. So today I'm only throwing out those three: SPY, Bitcoin, Ethereum, Tesla. There's other ones. I threw out Shopify. We talked about the VIX. Dollar's probably falling back, I would assume. VIX pulling back pretty hard right here. I don't know. I do have the dollar up, right? Yes, I do. Okay, yep. All right, so I want you guys to understand what the dollar's doing. So, as crazy as it sounds, look, dollar tried after the big pump. Dollar probably try again. Dollar try again. It's going to be a build short. Watch. And my expectations were they'd come back to here and then go. That was my expectations. To recapture all the liquidity below and then push off from there. So come back to 108, cool down, things consolidate where they are, and then take off, and then we get a massive dump. We'll see when that happens. I think November, December, we're going to see this next big leg down somewhere's in there, and then that'll probably be it. Yeah, that's it for today, guys. Like, that's a lot of conversation. I hope this kind of clarifies what's going on and helps you guys understand the market better and understand your next move. Be cautious. Don't be shorting bottoms. Try and short highs. Don't be too optimistic when you're at the highs. Be a little more cautious, we'll say. Until next time, I'll see you later.